Hello and welcome to our Lunch and Learn. SEC proposes climate-related disclosures. Before our webinar begins today, I would like to go over a few housekeeping items. In case you did not know, you can earn 1 CPE credit by attending our presentation today. To receive the credit, you must stay connected to the webcast for the entire presentation and participate by responding to at least 3 of our interactive questions. You will receive an email within 2 to 4 business days with instructions on how to access your CPE certificate. We also invite you to complete the course evaluation that will occur at the end of the webinar. We appreciate any feedback that you give us. Please note, we will not be having a question and answer period today, but if you have questions about this topic, we will be addressing the most common ones in the second part of this webinar series in July. I will now pass it over to our speaker, Amy Repepi, for the first of her 2-part series on the SEC proposals for climate-related disclosures. Amy, over to you.
Thank you. Good morning or good afternoon, depending on your time zones, and welcome to a topic that I actually find quite fascinating, the SEC's proposal on climate-related disclosures. I've been working in the Securities and Exchange area for my entire career, which is, at this point, about 40 years long. And yes, I still do look like my picture. From my perspective, this SEC proposal is perhaps one of the most significant proposals from the SEC in at least the past 10 or 20 years. In a nutshell, it would require disclosure of climate-related risks, greenhouse gas emission metrics, climate-related financial effects, and it would provide, in certain circumstances, for a type of audit report, referred to as Attestation Requirements, on some of the emission metrics. So we've got a lot to talk about. Let's move on. I think setting the stage with some terminology would be very helpful. I've got 3 to go over on this slide: climate-related risks, greenhouse gas emissions, and attestation requirements. You'll notice that I'm referring to climate-related risks and not climate change, which is the colloquial way that most of us refer to this broad topic. And while I can't speak for the SEC in terms of why they chose this specific terminology, I can suggest a reason, and I think it's because climate change as a phrase is hard to define. We don't always know specifically which type of climate-related conditions are a direct result of climate change, which are indirect, and which are just sort of normal. This is what happens when you live on planet Earth. The SEC has defined climate-related risks as actual or potential negative impacts of climate-related conditions, not only on the financial statements, but on the business operations and value chains of a company. It includes acute risks and transition risks, as well as chronic ones. I'll talk more about what transition means in a moment. Greenhouse gas emissions, this was a term I had to become more familiar with. Perhaps many of you are quite familiar with it. But simplistically, it refers to gases that trap heat in the atmosphere and therefore make the Earth warmer. There's a specific set of gases that are referred to as greenhouse gas emissions. They include carbon dioxide, methane, nitrous oxide, and various fluorinated gases. Last but not least, I want to mention the term attestation requirements. Think of this as a third-party report. When the SEC talks in its proposal about limited assurance, think of that as a quarterly review. It's procedures and a report that are akin to what public companies get when they get a quarterly review by their outside auditor. Reasonable assurance is essentially the same as an audit opinion. It's much more fulsome in the nature of the work done, and the third party that gives a report is actually opining. Now let's talk about what we're going to talk about today. I'm going to go through the why, who, what, where, and when related to the SEC's proposal, and my main focus will be on what disclosures are being proposed. That's the meat of the proposal. I'm sure that's what you're most interested in. And now for that first polling question. Do you currently subscribe to an accounting research service? You have 3 choices. Yes, a subscription to CCH Accounting Research Manager. Yes, another research service, or no, I do not have a subscription to an accounting research service. And while we're waiting for folks to answer that question, I am going to move on to the title slide. and indicate that our first section is going to be a discussion of why the disclosure rules are needed. Having a backdrop on what motivated the SEC to issue this proposal, I think, will be important to understanding the content of the proposal. Moving on. So, what's life like in terms of climate-related disclosures currently? To be blunt, there are no specific rules in the SEC's extensive codification of all kinds of rules and regulations that talk specifically about climate change or climate-related risks. However, about 12 years ago, the SEC put companies on notice that climate-related risks have potential significance that could require companies to talk about those risks in their SEC filings. In their interpretive release issued in 2010, the SEC introduced it by saying, and I quote, "Climate change has become a topic of intense public discussion in recent years. Scientists, government leaders, legislators, regulators, businesses, including insurance companies, investors, analysts, and the public at large, have expressed heightened interest in climate change." They said that in 2010. And in that context, although there were no specific rules, the SEC pointed to its general principles, which require disclosure of such further information as may be necessary to make the required statements in light of the circumstances in which they are made not misleading. And they also talked about the various sections of the SEC's existing rules that might require a company to talk about climate change. However, management was required to figure out whether or not climate-related matters were material, and if so, what information exactly should they provide? As a result of that SEC interpretive release in 2010, investors were presented with much more information than they had been in the past related to climate-related issues. However, in looking through what companies currently disclose, there's a lot of inconsistency. There's inconsistency across industries and within industries. Oftentimes, the information that's presented is boilerplate. It's a cut and paste that you see repeated over and over again. Interestingly, even though companies essentially are admitting that the information is material because they provide separate sustainability reports, they're excluding this climate-related discussion from their SEC filings, whether it's a registration statement, an annual report, a proxy statement, or an interim filing. A recent survey done by the Center for Audit Quality that was published in August of 2021 found that about 95% of the S&P 500 published ESG information. Now, ESG is an acronym that stands for Environment, Social, and Governance. But in the environmental subset of the information that they published, the CAQ found that these companies used very different frameworks for their climate-related disclosures. They often provided this information in separate reports, not within their SEC filings, and they used very different approaches to obtaining third-party assurance. As a result, in early 2021, the SEC put out a request for input. They asked for companies and investors, all parties, to think about how, if at all, should registrants disclose their internal governance and oversight of climate-related issues? What climate risk information could be quantified and measured? Where and how should climate change disclosures be provided? And how should the SEC regulate or guide those disclosures? They received an enormous level of input. More than 6,500 comment letters were received, including more than 600 unique letters. The distinction between those two being that oftentimes the SEC, as with other regulatory agencies, will get form letters. So when you look at the SEC's website, you'll see those form letters categorized as form letter A, B, C, D, and you'll see the number of form letters that came in that form. But putting that aside, people put pen to paper and issued more than 600 unique letters. I want to talk about the feedback they got from two communities, the business community and the investor community. The business community consists of all kinds of public companies, business associations, and industry groups. Some of the more recognizable names that responded to this SEC request for input included Microsoft, HP, Apple, Chevron, Dow, Delta Airlines, Bank of America, Tyson Foods, Walmart, FedEx, PayPal, Uber, Dell, United Airlines, Cisco. Surely you recognize many, if not all, of those names. The U.S. Chamber of Commerce wrote in. FEI, the Financial Executives Institute, did. A lot of industry groups for railroads, mortgage banking, life insurance, mining, oil and gas, and construction contractors wrote in. These comments were not uniform, not surprisingly. However, what did surprise me is that almost all of them agreed that the SEC should set some rules because of the growing investor input. And that was consistent with what the SEC heard from the investor community. They heard from individual investors. I counted at least 125 individual investors who wrote unique comment letters. And they heard from institutional investors, Vanguard, Morningstar, T. Rowe Price, PIMCO. They heard from investor representatives like the CFA Institute and the Council of Institutional Investors. They heard from pension funds like TIAA, CalPERS, and the New York State Teachers Retirement System. These folks almost unanimously supported the SEC doing some sort of rules. They encouraged the SEC to leverage off its existing frameworks, and like the business community, they encouraged principle-based rules with only a limited number of prescriptive rules. I included this slide on the SEC's principles of materiality because I think these notions are important to keep in mind as we both think about the existing framework for disclosure as well as what the SEC is relying upon in its proposal. For SEC disclosure purposes, there are two places where you can look and find out what the definition of materiality is. One is Rule 405. It refers to those matters to which there is a substantial likelihood that a reasonable investor would attach importance to the information. And then Supreme Court opinions. I've extracted a couple of commonly cited sentences, and you'll note that those also refer to the reasonable investor. So it's that individual or group of individuals that the SEC and companies should have in mind when they're thinking about what constitutes material information. Let me talk about who would be required to comply. And I can be quick on this. Essentially, all public companies. The only group that is exempt are asset-backed issuers. If you're a domestic registrant, if you're a foreign registrant, these rules would apply to you. The SEC does not make any exemptions for various subsets of public companies, which sometimes they do. For example, they will sometimes exempt smaller reporting companies or non-accelerated filers. Sometimes they exempt emerging growth companies or companies filing their initial public offerings. This is not one of those situations. These proposed rules would apply to all of these companies. Before I move on to what to disclose, I'd like to do another polling question. Does your organization currently disclose greenhouse gas emission data? You've got four choices. Yes, we do it in our annual report. Yes, in our separate sustainability report. We provide it both in our annual report and in a separate report. Or no, we do not disclose greenhouse gas emissions data currently. From what I can tell, most companies would be in either the separate sustainability report category or in the no, we don't disclose it category. I think it's relatively unusual for companies to provide it both places, in an annual report and a separate sustainability report. And while I think there's a growing interest in putting this information in the annual report that's filed with the SEC, to date, I think that that's an exception rather than the rule. The next section I'm going to talk about is actually the focus of the presentation. It's the meat of the matter, what disclosures would be required. I'm going to start broadly, and then I'm going to drill down with more specificity. At a high level, the proposed disclosures would require companies to address three areas: governance, risk management, and strategy. All companies would be required to address those. And the fourth category, targets and metrics or goals, that would be required if a company provides for that information In other words, if they voluntarily decide to disclose targets and metrics, or if it's regulatory or legally required. So those are the four broad categories, and some of that information is purely qualitative, and some of it is quantitative. Let me start with qualitative disclosures, and keep in mind this is still a proposal. Governance, risk management, strategy, and targets. Those are the four broad categories of qualitative disclosures. Under governance, companies would be required to describe the board of directors' oversight of climate-related risks and management's role in assessing and managing those risks. This includes whether and how the board considers climate-related risk as part of its oversight of the company's business, strategy, risk management, and finances. And if the board does not provide that oversight, the disclosure would be relatively straightforward. Nonetheless, it would be required to be addressed. Under risk management, the company would describe their processes for identifying, assessing, and managing climate-related risks. Within this category, if a company has a transition plan that they've adopted as part of their risk management strategy, the company would make disclosure of that. A transition plan is defined as the company's strategy and implementation plan to reduce its climate-related risks. We'll talk more about this in a minute. Under strategy, business model, and outlook, this is where the company would describe any climate-related risks that are reasonably likely to have a material effect on the business or the financial statements. And for purposes of this disclosure, you would use the materiality definition that I talked about a few slides ago. It's the broad principle related to what a reasonable investor thinks is important for purposes of making an investment decision. Therefore, under this category, some companies could have a fairly extensive discussion because, in fact, these risks are material. Other companies might conclude that some or all of their climate-related risks are not material and therefore provide much less information. Under targets and goals, metrics, these qualitative matters would be discussed if the company sets targets voluntarily or laws, regulations, or treaties require that they set targets. An example of a voluntary target would be a company that says that it plans to achieve 100% of the electricity used in global operations from renewable sources by 2050. That would be an example of a voluntary target that a company has established for itself and that would be disclosed as part of this proposal. There are quantitative disclosures as well. And anybody like me who has spent their career in accounting and finance is going to be keenly interested in the quantitative disclosures. There are two categories. First are the greenhouse gas emissions disclosures. Those are quantitative. And second are climate-related financial effects. And I absolutely will drill down more on both of these. For the greenhouse gas emissions and greenhouse gas emissions intensity metrics, all companies would be required to present certain metrics. Some metrics would be presented only in certain cases. But regardless of your size, there will be some metrics that you would be required to disclose. These quantitative data points would be presented outside the financial statements. They would not be inside the financial statements. They would be elsewhere in the SEC filing. Nonetheless, despite the fact that they would be outside the financial statements, in some cases the metrics would be covered by a third-party attestation report. In some cases, limited assurance, which is equivalent to a quarterly review, and in some cases, full assurance, i.e., akin to an audit report. That's greenhouse gas emissions. Climate-related financial effects would be within the notes to the financial statements. These numbers would be disclosed based on a very bright-line quantitative materiality threshold. And because this information, these numbers would be in the financial statements, they would be covered by the audit opinion. Before I drill down a little bit further, let me go through some more terminology. The SEC talks about transition plans and transition activities, and at first I found that a little bit confusing. But essentially what that means is, what does the company do, or what is it doing or planning on doing in order to reduce climate-related risks? That's what they mean by a transition plan or a transition activity. There are also three categories of greenhouse gas emissions called Scope 1, Scope 2, and Scope 3. And if you're well versed in this, I apologize, but I found this new terminology for me. So let me drill down a little bit and help you understand the difference, because the disclosures are distinct for each of these. Scope 1 emissions are direct emissions from the sources that are controlled or owned by the company. And the easiest example of Scope 1 emissions would be the emissions that a manufacturing company produces by virtue of operating its factory, or that a utility produces through its power plant operations, or that a transportation company like an airline or a trucking or a railroad company produces by virtue of operating their equipment. Those are Scope 1. They are directly from sources that are controlled or owned by the company. Scope 2 emissions are indirect, but they are derived from the company's operations. They involve, for example, the purchase of electricity, heat, or cooling. They result from the company's use of energy. So, for example, my little consulting company, we don't have any Scope 1 GHG emissions. We don't do anything that pumps anything into anything. But we do have indirect emissions because we have office space. We cool our office space, we heat our office space, we use electricity to power our equipment. We have Scope 2 GHG emissions. Scope 3 is the broadest category of emissions. They include both upstream and downstream emissions that result from the company's activities. And the easiest way I can explain this is to talk about a car manufacturing company. They have emissions that come from the products that they produce, that they buy, those emissions being the result of their suppliers creating greenhouse gas emissions in order to provide them with the component parts to manufacture the steel, to produce the aluminum, etc. On the flip side, they have emissions from their customers using the cars. So that would be an example of Scope 3 greenhouse gas emissions that would be produced, at least if you were a car company. And now you'll see why understanding those different scopes is important. The proposal from the SEC would require companies to disclose Scope 1 and Scope 2 greenhouse gas emissions, disaggregated by each type of constituent gas and in total. Scope 3 emissions would be required only in two circumstances. One, these are material, or two, the company has a target that includes Scope 3. And for this specific disclosure requirement, smaller reporting companies would be exempt. They wouldn't even have to address if this information is material. They would simply not be required to disclose it. Companies would also be required to disclose greenhouse gas emission intensity, which is a ratio that identifies the amount of emissions per unit of revenue and per unit of production. And then there would be some qualitative disclosures about methods and assumptions. And the SEC wouldn't require any specific method, and it would permit companies to change methods and assumptions as they find necessary, maybe to conform with others in their industry, maybe to adopt new approaches that evolve over the course of time. This information would be provided for the most recent fiscal year and prior fiscal years included in the filing. And the attestation report would cover just Scope 1 and Scope 2. For this purpose of the attestation report, non-accelerated filers would be exempt. So only large companies, i.e. accelerated filers and large accelerated filers, would be required to provide some sort of attestation report on their greenhouse gas Scope 1 and Scope 2 emissions. Who would provide this report? Well, it could be the audit firm, but it wouldn't have to be. It would have to be any third party that's an expert on GHG emissions, is independent, and performs engagements under professional standards. The proposal does not prescribe professional standards. It could be AICPA, PCAOB, it could be another country, it could be international auditing standards. However, The report would have to indicate if the third party is licensed, subject to an inspection program, and subject to record-keeping requirements. So I'm going to shift to the other category of quantitative disclosures now, the climate-related financial effects. And recall that this is in the footnotes to the financial statements. There are 4 categories of financial effects, and disclosure would be triggered using a materiality threshold that you would compute using a bright line test. You would present this climate-related information for all periods presented in the financial statements, and for this purpose, there are no exemptions and no scale disclosures. If the numbers are material based on this bright line test, regardless of your size, industry, or the type of filing that you're making, you are not exempt from providing this information in your audited financial statements. There are 4 categories of financial effects. 2 categories relate to the nature of the event, whether it's severe weather or a transition activity, and 2 categories relate to the type of financial statement effect, the impact on the financial statements or the expenditure. Disclosures would be disaggregated by category and by line item. Now, before I go further, I am confident that you are going to have tons of questions. I know I did as I read through this. I'm going to keep it high level for now. When we have our follow-on webinar, I'll go into more detail. And the other thing I want to stress is keep in mind this is only a proposal. I'm speaking just from my personal point of view, and this is just a personal opinion, but I believe that this is one area where any final rule would differ from what's being proposed. Nonetheless, let's talk about what they're proposing. There are 2 categories that I mentioned that deal with the nature of the financial effect. Those 2 categories are a severe weather condition or a transition activity. Severe weather or other natural conditions include floods, droughts, wildfires, sea level rise, anything that you can think of that relates to a severe weather or other natural condition. A transition activity harkens back to that definition I talked about earlier of a transition plan. Remember, that's a strategy or an implementation plan that a company adopts in order to reduce its climate-related risks. So in this category are activities that result from actions the company takes to reduce its emissions or to address its other climate-related risks. It doesn't have to be specific to greenhouse gas emissions. It could be other climate-related risks. The other 2 categories relate to the type of effect. The financial impact would be, for example, an impairment or a loss contingency. And then there are expenditures. Now, normally we think of expenditures as something that gets expensed to the income statement, but for this purpose, the SEC just defined expenditures as including amounts that are capitalized as assets. When you put that matrix together, you get this. You get severe weather conditions that could have a financial impact or could be an expenditure, and you have transition activities that could have a financial impact or could be an expenditure. These are the 4 categories of financial effects that need to be identified and measured in order to determine whether or not they have to be disclosed. I've given you some examples on this slide. So, for example, the financial impact of a severe weather event might be a $5 million impairment charge because an asset such as a warehouse was damaged by a hurricane or by a wildfire or by a flood. And keep in mind that we don't need to know whether or not that wildfire or flood or hurricane was the result of climate change. This looks at simply severe weather or other natural condition. However, you could also have an expenditure related to severe weather or other natural condition. For example, you have assets that are in risky locations and you expend money in order to move those assets to a less risky location. That would be an example of an expenditure that would fit within this category. But maybe you're not affected by severe weather or other natural conditions. Maybe what's going on are transition activities. You can have both financial impacts and expenditures there too. For example, the financial impact. More and more frequently, we're seeing companies issue bonds, debt instruments, where interest expense is linked directly to the company's achievement of a specific climate-related target. Could be greenhouse gas emissions, could be something else. To the extent that a company was unable to achieve that climate-related metric, if interest expense increased because they didn't achieve it, that would be an example of a financial impact of a transition activity. A much more straightforward example of a transition activity would be an expenditure to buy an asset with the asset's purpose being to reduce greenhouse gas emissions. And depending on your materiality thresholds for your capitalization policy, you would either be expensing some of these things, or in this particular case, you'd probably be capitalizing it. So again, this expenditure category is not necessarily just an expense charge to P&L. It could be an asset that you capitalize. I mentioned that these disclosures would be required if they're material. And while those qualitative disclosures look to the broad principles of materiality, these disclosures do not. For purposes of the information provided in the footnotes to the financial statement, the SEC is proposing a bright line threshold. You would disclose this information if the amounts are greater than or equal to 1% of the line item. So for example, if the impairment charge related to the asset that was damaged by severe weather was recorded in cost of sales, you would look to see whether or not the effect is greater than or equal to 1% of the cost of sales line item. The interest expense that I mentioned earlier, you would look to see whether that $400,000 increase in interest expense is greater than or equal to 1% of your interest expense line item. Computationally, you would look to the absolute values of the effects of climate-related matters. There are cases where you could have a positive effect, i.e., a credit to the income statement. As an example, inventory has been damaged by severe weather and you have an insurance recovery. The write-off of the damaged inventory was a charge to P&L of $500,000, but you also had an insurance recovery. In this case, for purposes of computing materiality, you would use the absolute values of those two numbers, and therefore your materiality would be $700,000 divided by whatever line item this was included in. If that $700,000 were material, you would be required to disclose the negative and the positive effects separately. So you wouldn't disclose $300,000 net charge. You would disclose each of these two components. Obviously, there would be some qualitative information around this. How are the amounts derived? What significant inputs and assumptions did you make? Were there specific accounting policies related to this information that you should share with your investors? Another very important point to stress is that to the extent that you disclose targets and goals and commitments in the narrative section under those qualitative disclosures we talked about earlier, you would be required to disclose the expenditures and costs to meet those goals. And again, because this information is in the financial statements, your independent auditor would have to cover this information in their opinion, and this information would be subject to the company's internal controls over financial reporting, both for purposes of management's attestation on their internal controls and for the independent auditor to the extent that they're required to provide that. I know that's a lot to absorb. I know you have a lot of questions. If you'd like to jot those down and send them in, we'll try to get to them next time. But also, to the extent that you have thoughts about this, you should think about providing those thoughts and reactions to the SEC. Input is sought and welcome. Another polling question. As proposed, Which companies would be required to disclose greenhouse gas emissions data in their SEC filings? Almost all public companies? Only Fortune 100 companies? Public and private companies? Or none of the above? I'm going to move on quickly to the final two sections, which deal with where to disclose the information and when these rules might be effective. Let's do the where. Registration statements and annual reports. So whether you're filing an S1 or a 10K, or if you're a foreign registrant, an F1 or a Form 20F, which is the 10K equivalent for foreign registrants, these disclosures, everything I just talked about, the qualitative disclosures about governance and risk management and strategy and greenhouse gas emissions, the information that would be included in the footnotes, the financial statements, all of that information would be presented in registration statements and annual reports. The proposal does not specifically call for quarterly disclosures. Rather, it suggests that to the extent that there have been material changes since the last annual report, those material changes would be required in your 10Q. That's generally the way many disclosures on an interim basis work. Sometimes the SEC has specific incremental pieces of information they want, and if so, they'll delineate those. But in this case, at least for purposes of the proposal, you would only be required to disclose material changes that have happened since the information that was provided in your 10K. In terms of the organization of your filing, the qualitative information related to governance and risks and strategy and targets, as well as all of the quantitative greenhouse gas emission metrics, would be in a separately captioned section. So for an investor, rather than having to turn the pages and seek out information in various subsections, all of this information would be in one separate section of the filing. And of course, the climate-related financial effects we just went through very quickly, those would be in the notes to the financial statements. Take a deep breath. Let's talk about when this information might be required. I want to underscore the fact that the SEC has not proposed any effective date. I'm going to go through an example in a bit that assumes an effective date, but that's hypothetical. It is solely for purposes of trying to illustrate how the SEC would phase in these various requirements. So for now, we have no effective date. We don't know whether it would be 2022, 2023, 2024. We don't know. What we do know is that they're proposing a phase-in wherein the largest companies would go first, and the phase-in would happen over several years. Let's talk about the phase-in timeline for disclosures. In order to illustrate this, I had to pick an effective date. So just to make it simple, hypothetically, if a final rule became effective in December of 2022, here are when the disclosures would be required. And you can see that the large accelerated filers would go first, followed by accelerated and non-accelerated filers, with smaller reporting companies being 3 years out. So it's phased in over 3 years, largest companies going first. This is actually in the proposal itself, this phase-in approach to implementation. For purposes of these disclosures, everything but the Scope 3 greenhouse gas emissions would all be required at the same time. More time would be permitted for Scope 3 greenhouse gas emissions. Recall that smaller reporting companies are completely exempt from this disclosure, so they don't need to worry about that. But if you were a large company and this rule became effective at the end of 2022, you would have to be in a position to provide the Scope 3 greenhouse gas emissions by the end of 2024, the year ended 2024, so that would be your 10K if you're a calendar year company that's filed in the early part of 2025. There's a separate phase-in for attestation reports. Again, non-accelerated filers and smaller reporting companies don't have to worry about this. In no circumstance are they required to provide any kind of assurance report, not limited assurance, not reasonable assurance. Large accelerated filers, again, would go first. The very first year that they provided this information, they would not be required to provide a report. For the next 2 years, 2024 and 2025, they would be required to provide limited assurance, again, similar to a quarterly review report. And then only in that third year out, 2026, would they be required to provide reasonable assurance. For accelerated filers, you take all of that out at least another year. They don't have to make any disclosure in their first year. They have no assurance in the first year that they make the disclosure. Limited assurance then kicks in 2025 and 2026. And finally, they end up with reasonable assurance reports being required beginning in 2027. I have a few final thoughts. I'm sure you've got a lot, but let me go through mine. I started out by saying, from my perspective, this is one of the most significant SEC proposals in at least the past 10 or 20 years. And I think one data point that underscores how significant it is the SEC's own projections of how costly this would be for companies. The SEC's projections included in the proposal indicate a range of $350,000 to $450,000 of costs per year for a company to comply with these disclosures. That's a big chunk of change. Obviously, larger companies it might be more expensive, smaller companies it might be less, but it might not be based on size. It might be based more on the nature of the company's operations and activities in terms of exactly what data they need to gather for purposes of putting all the required disclosures together. I think the last SEC proposal that resulted in a very large expenditure for companies was Sarbanes-Oxley and the rules requiring reports on internal controls over financial reporting. I don't recall how much the SEC's estimate was, but it might not have been quite this large. But again, I think this is a fairly significant proposal. And again, I think the evidence of that is the SEC's own projections of how costly it would be to implement. The comment period was extended. It now ends on June 17th. Today's June 1st. You have 2 weeks if you wanted to send in a comment letter. The proposal itself is 500 pages long. It has all sorts of sections and subsections and all sorts of areas where you could choose to comment. There's no requirement to comment on anything or anything for that matter. But if there's 1 or 2 or 5 or 10 things that you would like to offer a point of view on, you absolutely can and should do that. The SEC website offers a simple way to provide input. I've put the SEC link on the slide. You don't have to provide a formal comment letter. You can use the SEC's form in order to submit a comment. And as I've scanned through some of the submissions that have already been provided, I see a lot of comments coming in on this form. I don't have a crystal ball. I don't know exactly what will come about. I do fully expect significant pushback. I think anybody who reads the Wall Street Journal would realize that there are any number of interested parties who think that this is too much, it's gone too far, that the SEC doesn't have jurisdiction, that this could even be a problem from a First Amendment freedom of speech perspective. So there's no question that the SEC will get a lot of pushback. I also think they're going to get a lot of support. Now, whether every aspect of the proposal gets a lot of support, I can't say. But given the input that the SEC received when they asked for constituents to express a point of view on whether climate-related matters should be part of the SEC's rulemaking toolkit, I do think that there will be those who do express a significant amount of support. I'm going to cover more information after the comment period ends. Going to give me a little while to read through as many comment letters as I can manage to get through, synthesize those, and come up with some hopefully interesting viewpoints on what the constituencies said to the SEC. And I'll also drill down a little bit more on some of the financial statement matters, because I think these are things that most companies will be at least mulling over, even if they believe that the final rule will change. The SEC has produced some sort of interesting thoughts, and it may cause companies to think about information that they think they ought to be disclosing on a regular basis, irrespective of what a final rule says. So at this point, I am going to turn it over to Matt, and he is going to provide you some additional information about Accounting Research Manager.
Thanks, Amy. Some really good, insightful information here. Hopefully, everybody can see my screen here. I'm going to go ahead and share the website here for our Accounting Research Manager. This is our flagship A&A product. So from an accounting and audit standpoint, this product is extremely helpful, whether it's looking up FASB codification information, looking up accounting standards, accounting standard updates, so the ASUs, our interpretation and expert analysis of what the authoritative bodies are saying. This product really pulls everything and ties everything into one place. So I'm going to spend a few minutes just kind of going through the layout and kind of show you really how the feature functionality works of Accounting Research Manager. But I'll also spend a few minutes going into a tool that we have called 10K Lookup. And 10K Lookup allows you to be able to go in, look at a complete filing, whether it's a 10K, 10Q, 8K, S1, whatever it may be with the SEC register, you have that information right at your disposal. So I'm going to go ahead and just briefly click on our current pronouncement highlights, and this is actually updated every 2 weeks. So go ahead and clear out my screen. Sorry about that. This is actually updated every 2 weeks. You'll see we just recently put one out at the end of last week on the Russia-Ukraine war, various financial statement disclosure considerations. But the second one here that occurred that we put out back on the 15th of May actually does a really good job breaking down the various components that Amy had just discussed, whether it's climate-related risks, greenhouse gas emissions, so those phases that we were talking about, scope 1, 2, 3. Once again, climate-related expenditures, how things are disclosed within the financial statements itself, various assurance or attestation requirements that may be forthcoming. Once again, keep in mind that this is proposed legislation, but we do a great job from our editorial standpoint going ahead and highlighting these particular areas that you need to be aware of moving forward. So I just kind of scroll down the screen here. Hopefully everybody can kind of see what this document includes. There's 12 pages here, but once again, individual investor issues, political issues, other constituent issues, things that are tied directly to this particular area for climate relation disclosures would be covered in this particular document. And once again, within the service, just to kind of give you a better idea of how Accounting Research Manager is laid out, you'll see here we always have various flags throughout the service. And this brown flag right here will tell me that I'm in our interpretative guidance, which is our editorial-based information, as opposed to if this flag was gray, it would actually say authoritative. So you would know that you're in an accounting standard, an auditing standard, that type of authoritative material. So I'll go ahead, I'll just go back and hit my home page. And another nice feature, I'll show this in a minute, along with the keyword searching that everybody's used to doing. If you use Google or any other type of search engine to go through, you can do a keyword search in here at any time for any particular subject matter that you're looking for. Like I said, whether it's SEC regulatory, whether it's an accounting or an auditing standard, you can always keyword search it. But one of the things I wanted to show you how this is designed and laid out is we actually have what's called ARM topics A to Z. And I'll just go into the all topics area. And if I go ahead and hit E for environmental social governance, it'll shoot me right down to that section. So I can go right there, click on that ESG reporting. And once again, it's going to take me to the regulatory information. This was listed out here by the commissioner, Allison Lee. We've also got any other related documents. There's a AICPA Center for Audit Quality document that's listed in here. I won't go too far into the details, but you'll see it's directly from the AICPA on reporting for ESG and attestation roadmap for audit practitioners. And that's from the Center of Audit Quality. I'll go ahead and hit the home page and we'll go back. It's really clean and easy to use as far as the layout of Accounting Research Manager is concerned. There's really four main boxes here. There's the accounting section that you can subscribe to. So if you're a practitioner that only needs accounting standards and that type of material, as well as our interpretive guidance on it, there's this section for you. There's our SEC regulatory and practice coverage that Amy was speaking of, from the SEC standpoint. Once again, being able to go in and search that topically and do keyword searches from the keyword search bar above. And then the auditing piece. So if there's specific industry types that you do audit work in, whether it's single audits, governmental, whether it's HUD, any other type of employee benefit plans, those types of areas, we have coverage specifically towards our knowledge-based audit methodology that you can subscribe to as additional add-on pieces to the existing ARM library. From there, we've got internal controls. So if you've got specific IC issues, PCAOB, if you're a PCAOB member firm and you have those publicly traded companies that you're doing audit work with, you've got all the PCAOB coverage, SEC, once again, COSO, AICPA pronouncements. All that information is covered, as well as governmental. So if you are a municipality, you do governmental work from a CPA firm auditing standpoint, we've got that all covered as well. So I'm just going to go ahead and I'll scroll back up. I wanted to go into that 10K lookup, so I'm going to go actually into tools. It can be found in either place, right here on this tab, or at this tools on the home bar. So I'll go ahead and hit that, and I'm going to hit 10K lookup, and it's going to open up a new screen that allows me, once again, to do keyword searches on specific areas. So if there's specific footnote disclosures that I want to look at in a 10K annual report for a specific company or specific type of industry, like chemical, for example, I want to look up Dow Chemical and I wanted to look up their annual report. I could do that right from here, but I'm just going to go ahead, I'm going to click here and I'm going to do a keyword search for climate related. So we're going to try to capture everything dealing with climate related activities or events. I'm going to choose from the drop down. You'll see we've got most common types of SEC forms, 10K, 10Q, 8K, S1, whatever it may be. I'm just going to go ahead and choose the 10K. And then from industry, I'm going to scroll down kind of towards the middle here, and I'm going to choose banking. And the reason I'm going to do that is that's a little bit unique, for an industry dealing with climate issues, as opposed to maybe chemical companies, right? Where we all know that they've got climate related issues or waste disposal issues and things that affect greenhouse gases and other type of emissions. So I chose banking. I'm going to go ahead and run my search. And you'll see here we've got 49 results here found, and these are all different type of banking companies that file their 10K with the SEC. So this one back on March 30th of this year, I'll go ahead and click on the actual form itself. And within the body of the 10K for the First National Corporation, it'll actually take me to the section that's dealing specifically with climate related issues. So once again, it's doing a keyword search within that particular 10K filing for First National Bancorp. So I'll go ahead and just click on this first one, and it's going to open up in a separate dialog box here, separate window, and I can scroll down to that area that's highlighted in yellow text is where it's doing the keyword search. So this is dealing with climate change and related legislative and regulatory initiatives that may result in operational changes and expenditures that could significantly impact this company's business. You can read once again in here, various factors, various initiatives for lending communities that may come up, having to deal with climate related activities and risks that they're adding into their disclosures on their 10K. I'm going to go back. I'll hit the home page, and I'll go back into tools. And one of the things I did want to point out is we have a really good area and really good grasp on what's coming up as far as SEC regulatory information, accounting standards, auditing standards, anything from the authoritative bodies. We've got coverage on within the what's new checklist and the effective date checklist. And I'm going to go ahead and click on the what's new checklist. And through here, you'll see we do a nice job, once again, every week going in here and updating these particular changes for that particular week. And you can see, we've got items from the past 3 months that are in here. But I'm going to scroll down past the FASB, past the International Accounting Standards. I'm going to go into the SEC. And once again, from here, from late last week, I can see any new items that have been changed in the past or added in the past 3 months, any updates that have occurred in the past 3 months, and I can scroll through here, and within the body of the summaries, I can actually click on the actual doc, that little piece of paper icon, and open up that particular SEC release. From here, you'll see, once again, I had mentioned that brown flag earlier. The brown one meant I was in our interpretations, which is our CCH ARM editorial analysis section, but this blue flag tells me that I'm in the SEC proposal. The nice thing is if you go ahead and print this off, if you were to save it in a PDF or a Microsoft Word document file, if you were to share this with a colleague, these flags always remain on the document. So once again, I know this is an SEC proposed document as opposed to something that CCH is interpreting on an SEC coverage or SEC proposal. So once again, these flags are very, very helpful to know where I am. We've also got a breadcrumb trail, what we call, within the very header of the library, so you always know exactly where you are at any given time. I know I'm in the SEC practice section. I'm in Chapter 7 under SEC rules, and within the rules, regs, and releases, I'm in this particular area for related disclosures for investors. So I'll go ahead and hit the home button. It'll take us back. One other area I did want to, we're coming up on the hour, but I did want to mention was in the tool section, that effective date checklist. Once again, we always go in and update any changes within the US accounting standards. So FASB, IFRS for international financial reporting, the AICPA professional standards, and GASB. We've got all this information actually in one place, because a lot of times practitioners want to see, okay, what's changed as far as an ASU? Well, you know, the accounting standard update, what has changed for this week compared to maybe last? And if there's any effective dates that have changed that are going to impact my client. So I've already clicked on the one for the US accounting standards for that checklist, and you'll see it pulls it up in an Excel document. Within that Excel document, I'm in the chronological order tab here. We've also got an earliest effective date order tab. But within here, you can actually read about the effective date. You can see our editorial comments section. You can click on these blue areas. Every one of these are hyperlinked text within the body. And you can also see the earliest effective period for those particular ASU changes. So once again, if I do want to click on one of these, I can go ahead and do so, and it's going to shoot me right into that ASU, that accounting standard update for this year. So once again, I can do more and more reading or more and more research on this particular topic area. And once again, there's that gray flag that we have telling me that this is from the FASB and it is authoritative, as opposed to SEC proposed or our CCH analysis section from our editorial staff. If you have any questions, I am the lead product manager for Accounting Research Manager. If you have any questions, please definitely feel free to get a hold of us. You can also go to our Accounting Research Manager site, which is found fairly easily as far as going to Google and just typing in CCH Accounting Research Manager. It'll take you to our home landing page, and from there you can request a free trial, a week's trial of this particular product, or you can go ahead and contact us directly if you need a representative in your area to contact you directly. So that's pretty much concludes my demonstration of the CCH Accounting Research Manager, or ARM as we call it, and I'll pass it back to you guys.
Thanks, Matt, for that great demonstration of CCH Account Research Manager, and a thank you to our speaker, Amy Repepi, for a great and informative presentation. Amy will be back in July for another Lunch and Learn with more information on this developing issue. This will be the final polling question. The question will remain up as we wrap up today's event. Today's Lunch and Learn will conclude once this polling question is completed. As a reminder, there will also be a few quick survey questions for you to complete following the webinar. For anyone who answered at least 3 of the required polling questions and stayed connected to the entire webcast, you can expect to receive an email within 2 to 4 business days with instructions on how to access your CPE certificate. Please note, the instructions will be sent to the email you used to enroll for today's event. Thank you all for attending our June Lunch and Learn, and we will leave the question up for another 30 seconds. And this concludes our webinar today. See you next time.